When we're making a recommendation, we don't have a crystal ball on what any clients are going to claim on. If that was the case, we would perfectly tailor the insurance provider based on that.
They call it total and irrecoverable loss. So basically, you can't recover from it. So if you lose both hands, or you lose both feet, or you lose the sight in both of your eyes.
Sometimes their policies have like PR definitions, but MetLife says that, you can give it a go, because essentially we want you to try and get back to work. But if you can't, and then you're assessed as totally disabled, then we'll make a payment.
When you try to make a claim on your TPD policy with AIA, it then reverts to the work you were doing when you were last generating an income.
But if your policy's outside of super, you can actually hold it until you're 100 years old.
Yep.
Now, big disclaimer, premiums are going to be crazy high at a 99-year-old to hold a TPD policy. Hey there, it's Phil Thompson here for another deep dive episode. And today we've got Natalia King again talking about TPD. G'day, Nat. How you going?
Good. How are you, Phil?
Great. Now, we did a relatively niched deep dive last time, any versus own OC TPD. Now, anyone who's got TPD needs to know about that. Now, we're going even deeper. So this is an extra deep dive. And so we're going to talk about own occupation TPD. What are the differences between the different insurance companies? Quick disclaimer, the information we're going to talk about today is based on today's product. So in a week's time, an insurance company could make a change to their product and it could be completely different. So always, if you're watching this in 3 years' time, check the date. It's true as of today, but it may not be true when you're watching. So, Nat, let's kick us off. So just give us a too long didn't read understanding of any versus own occupation, just in case someone doesn't want to go and watch that old video.
Cool. Or TLDR, which I just learnt what it was today.
That's it. Now you're a cool kid.
So two definitions for total and permanent disability. The any occupation is one that is most common and held inside those group insurance policies in super. If you are unable to do any job that you're reasonably skilled or qualified or have prior experience in doing, that's where you'd be able to make a claim. The other definition is an own occupation definition. So if you are unable to do your own job that you are doing at claim time or when you apply for the policy, then you'll be able to make a claim on the policy.
Awesome. Now that's good. Now talk about the different definitions. So we're talking about own occupation disability today. So talk about the different definitions between the insurers.
Cool. So I'll list them out as we go because it's easier that way. As Phil said at the start, this is based on today, so who knows what's going to happen tomorrow or in 4 hours' time. Ascender have own occupation as the occupation that you are doing at time of application, unless you change occupations after that. If you have changed occupations, you need to be in that new occupation for more than 6 months continuously prior to disablement, so prior to the date that you're sick or injured. If you haven't been in that new occupation for more than 6 months, it'll revert back to whatever you have applied for when you take out the policy.
So let me touch on that because I'm a bit slow. So Ascender, formerly MLC, what they say is it's your own occupation when you apply for the cover. But if you've changed occupations and you've been in that occupation for a significant amount of time, then it's your new occupation. Is that correct?
Yes, correct.
But if you've been there for 3 months, then it's going to be the occupation as of the time of application, which is interesting because if you took out a policy 10 years ago and you've changed occupations multiple times, but your newest one is within 3 months, then it will revert back to the original application.
Yeah, which is interesting. AIA is the job or the occupation type of work that you're doing immediately prior to the date you're disabled. With AIA, if you are doing more than one job, so working in more than one occupation, it includes all of those occupations. So if you're, working as a financial planner, but you're also in hospo, it includes both of those occupations, and you need to show that you can't do either. If you are not working at all, when you try to make a claim on your TPD policy with AIA, it then reverts to the work you were doing when you were last generating an income.
So again, back to real life examples. If you are on parental leave at the time you make a claim, whatever you're doing prior to parental leave is what they will consider your own occupation.
Clearview is similar, but it's only the most recent occupation that you've engaged in. If you're unemployed or on leave, so on sabbatical or parental leave for more than 12 months at time of disablement, Your TPD is actually assessed under an any occupation definition rather than the own occupation. If you're not working and you're off for more than 12 months, then it actually reverts back to that any occupation you're reasonably skilled or qualified to do.
And then once you're back at work for a day, then it'll be based on that.
Correct.
That occupation. Yeah, correct.
For Encompass, it is the occupation that you are doing at time of application, unless you've changed occupations. If you have changed, you need to be in that new occupation for more than 6 months continuously. However, if in the 12 months prior to making a claim or prior to the date of disablement, you're on leave or unemployed, they will assess you at home duties. So you won't be assessed on the own occupation. It'll be assessed very similar to Clearview, but on a home duties occupation.
Which basically means you need help, in your activities of daily living. So you've got to be significantly disabled to make a claim on that policy. Are there any other insurers that we haven't touched on? Sorry.
We got MetLife so MetLife's is the most recent occupation you were doing prior to the date of disablement. NEOS were very similar to Encompass, so it's the most recent occupation you've engaged in. But if unemployed or on leave for more than 12 months, it's then assessed under that home duties. OnePath is the most recent occupation you were doing prior to date of disability. PPS specifies a primary occupation at time of injury or illness, or the occupation at the commencement of the policy if you're not working prior to disablement. TEL was very similar to AIA. It is the occupation that you are doing prior to date of disablement, but if you're working in more than one, it'll include all of those occupations that you've been engaged in. And for Zurich, it's the occupation you're doing at the start of your disablement, so sickness or injury. If you're not working, then the own occupation is the employment that you have most recently worked in where you've earned money. If you've worked in a new occupation for less than 6 months, it goes back to the previous occupation, not all the way back to the start, but just back to the previous one if you've changed jobs.
No one knows when they're going to become disabled. If we did, we would get a policy, a year before that and not waste our money on premiums otherwise. It is one of those things that each definition is really important, and it's when you need to claim on these policies is when it becomes the most important. And so understanding what that is. And there are cases where if you haven't been working because of an incident for a number of years and then you make a claim a few years later, they will assess, okay, well, yes, you haven't been working, so we're not going to assess it in the activities of daily living or home duties or in any occupation, because at the time that you became disabled is when they will make that assessment. So even if you are trying to recover and get back to work and you spend a few years doing that before you submit a claim, they'll backdate that date of disability. It is very nuanced. There's a whole bunch of factors when it comes to this, but is there anything else that is factored in when it comes to making a claim? So is it just you've got to meet this own occupation definition, or is there any other factors that you can potentially make a claim on?
Good question. There are, for the insurers, other things they look at in terms of not being able to work, or so not even not being able to work, but the other, I guess, trigger would be if you've suffered, they call it total and irrecoverable loss. So basically you can't recover from it. Examples of those. So if you lose both hands, or you lose both feet, or you lose the sight in both of your eyes and they are not recoverable, you can't reattach them, then you'd be paid out your TPD. If you suffer losses, so you lose one hand and one foot, then you'd be able to make a claim. If you lose 1 foot and sight in one eye, so two disabilities, then you'd be able to make a claim, or one hand and sight in one eye as well.
So there are examples where, if that happened to me, I lose a hand and I lose sight in one eye, that would be annoying to go to work, for sure. I type most days, all day, every day. But, with the, technology, being able to voice to text, all of that stuff, it may not limit my ability to go to work. So, but you're saying that we can still get paid a TPD claim if that happens, even if it doesn't mean I can't do my occupation.
That's what the PDSs all say. So that's where the insurers stand at this point. Yeah.
Yeah. And this is one of the things that, to be honest, it makes up such a small portion of their claims. So they do it as more of a, sometimes their policies have PR definitions. If someone's lost their sight and lost their hand and the insurer says, well, actually, Phil, you're a financial advisor, you could just do voice to text and you'll be right. Yes, it's going to slow you down, and will impact your productivity, but you can still work. There's sometimes the features that they go, well, one of the insurers brought it in, then the others went, actually, it probably makes sense because it's not going to impact our claim stats significantly.
Yeah.
How often is that going to actually happen? But we don't want to go into today, tonight, and have to argue the fact that we didn't pay out for these situations. So, yeah, there are some of these benefits. Is there anything else that the insurers kind of assess to have these kind of feel good or PR claims that I call?
Yeah, Zurich have if you are 60% of your, or 60% impaired, there's not a requirement about not being able to work, but if you are 60% of the way completely impaired and you survive 14 days, then they will pay out the TPD claim as well. Be around that, if you declared brain dead, then you're essentially not surviving 14 days. You've got to be not brain dead by the end of the 14 days to be able to qualify for that one.
And again, if you're linking life with it, these things happen and you do pass away within 14 days, hopefully you've got a life insurance policy that's claimable. So there are some of these things where, you do need to survive a certain amount of time to get paid a TPD payment. But at 60%, we're not doctors. Sorry, I know, Nat, you've done a law degree, you've done finance degrees, but have you done your doctor? No, you're not a doctor? Okay, good. But there are assessments of whole person impairments. And so, 60% is pretty significant when it comes to that impairment. So it is for really significant injuries that happen. You don't need to prove if you can go back to work or not. There's none of this, hoo-ha around that. It's just, I do meet that definition, we'll pay out a claim.
Yeah.
So talk about how long do you need to be disabled before they will pay out a claim? So there's a time frame of when your date of disability is and when they will make that claim assessment?
Yeah, so date of disability is the date that you are sick and injured. You need to show that you've been off work for 3 continuous or consecutive months, completely uninterrupted. So 3 months is that time frame before you'd then be able to be assessed under the TPD policy. There is one insurer, MetLife, at this point in time, that have a clause in there that says if you are back at work under a rehabilitation program, they won't restart that 3 months absence. They will just, it's still kind of included in that 3 months. So you've tried the rehab, you've gone back to work, it hasn't panned out. At the end of the 3 months and the rehab hasn't worked, you'd still then be able to go down the claim route.
And it's one of those things like, if people hear that and go, well, hold on, you've got to be totally and permanently disabled to get a payment, but you're talking about, 3 consecutive months off, don't you have to have, forever off work? That is the case. But if you are, things like chronic fatigue or mental health that are claimable events that may lead to a TPD payment because you cannot work in your own occupation. But, for mental health, for instance, if you give it a go and try and get back to work and maybe do, half a day here or half a day there, some insurers will say, well, actually, no, that restarts your 3-month period.
Yeah.
And, at which we will assess the date of disability. But MetLife says that, no, you can give it a go because essentially we want you to try and get back to work. But if you can't and then you're assessed as totally disabled, then we'll make a payment. And fun fact, we actually had a client who made a claim on TPD and the date of disability was prior to a renewal, a policy renewal. And then this 3-month period was after the renewal, which means we had indexation on the policy. So the levels of cover went up and the premiums go up because of it. And so this 3-month period sounds like it may be in the insurer's favour or they're trying to make it harder to claim. Actually was in the client's favour because they got that indexation increase. So it was like an extra $50,000 they got paid out because of this, the timing of the date of disability and then plus 3 months. Talk to me about when do these policies expire? Can we have a TPD own occupation forever? Do they run out? Do TPD policies expire? Talk to me about that.
Yeah, again, very nuanced among the insurers. They all kind of have a different definition of it all. For some of the insurers, rather than going through every single one, for some of them, the TPD policy expires at age 65. So basically, the renewal before you turn 65 is when the TPD policy will expire. and it no longer exists. For others, so AIA being one of them, you can keep the own occupation or the occupational definition until age 70 for white collar, or age 65 if you're not in a white collar profession, and then it flicks to a loss of independence definition after that.
Yeah, basically a activities of daily living style, you need to be significantly disabled before they'll pay out a claim. So you still pay your premiums, but it's not based on your ability to go back to your own occupation now.
Yeah.
After age 70 or 65, depending on occupation, it then converts into a much more difficult TPD policy to claim on.
Yeah.
Is there anyone else that has that kind of similar nuance, or is it just AIA that does that?
NEOS, OnePath, PPS, and Zurich all have a similar nuance. Whether it be 65 or 70, it flicks to either a non-working occupation or loss of independence, which are both relatively similar in definition.
And I did see in the thing, the PBS policy, so the actual policy, yeah, it converts at age 65, but then you can hold it until age 80 if it's inside of super. But if your policy is outside of super, you can actually hold it until you're 100 years old.
Yep.
Now, big disclaimer, the premiums are going to be crazy high at a 99-year-old to hold a TPD policy. So in reality, people don't hold their policies that long, but at least some insurers will require it to be cancelled at age 65. Some insurers will allow you to maintain it. And so it gives the policyholder the choice and the options to keep it if they want to. All right, talk to me about, are there any other differences between providers that we kind of haven't really touched on yet?
Good question. There's one that I found with AIA. They have a day one TPD payout. So that 3-month time frame off work that I was talking about before, with AIA, if you have a serious crisis event, so Alzheimer's, MS, or multiple sclerosis, get diagnosed with a motor neuron disease or Parkinson's or paralysis, you actually don't have to satisfy that 3-month off work. You get paid out the TPD on day one. You've just got to have 1 day off work.
Okay. Anything else, or that's the kind of the major, outside of anything we've already talked about with regards to the differences?
That's the major difference between them all.
All right, so I will ask you the question about the difference between the claims, but talking about the differences, the policies are very nuanced. Now, does the different policies influence your recommendation to clients? So, would you go for the Zurich policy that has that option for 60% whole person impairment option, or the way in which they assess your occupation at claim time? Some of them base it on your own occupation prior to being off work. Some will, if you're off work for 12 months, change the definitions. Would that make a big influence on your recommendation to clients?
It's a really good question. Not really. The price factor, the cost differential between insurers comes up kind of first, but the only one that I'd probably consider a little bit closer if there's really small differences would be that, if you are off work for 12 months, it'll be assessed under an ONOC or a home duties. That would probably be, if we are applying for an own occupation definition on TPD, that would be where I'd kind of look at it and go, if there's small differences between them, maybe it would influence, but not hugely, no.
Yeah. Yeah, and I guess my philosophy is these things matter heaps when it comes to claim time. And so it is very important to understand your policy. If you're claiming on it, what does it look like? Because it's a material impact on the claims. But given when we make a recommendation, we're looking at like life, TPD, income protection, trauma. So one insurance company may have, maybe a lacking definition on the own occupation TPD, but a great definition on income protection. And so there is so many things that go into a recommendation for our clients, and not even regardless of underwriting differences or pricing differences, there are so many factors. And the other thing is, when we're making a recommendation, we don't have a crystal ball on what any clients are going to claim on. If that was the case, we would perfectly tailor the insurance provider based on that. So there are some, trauma definitions that have great, I think AIA was talking to us this morning, have great prostate cancer definitions, market leading. Well, that's great, but, am I going to get prostate cancer? I don't know, maybe. But, will I pay 20% more for that if the premiums are 20% more for a client? Well, probably not. So there are so many factors when it comes to making an initial recommendation on the insurers, that we take these definitions into account. They're super important. But it's more, I guess these deep dives are really more to think about if you do need to claim, really truly understanding the policies that you've got. So my next question, Nat, is like own occupation payments. Like how does that work? Like when we make a claim. So if we make a successful claim, like how does it work? Why is own occupation important?
Yeah, good question. If you make a successful claim on own occupation, so own occupation, as we spoke about in the previous episode, which you can go back and look at, can only be owned outside of super. So you need to pay for that own occupation component of the definition of TPD personally and pay it through cash flow. Why that's important is if you paid out, it'll be paid straight into your bank account and you won't have to worry about any tax effects of getting it paid into super and then withdrawing it that way. And I think that was the main part.
Yeah, and I did talk about having a client who made a claim and fortunately ticked over to the next renewal date, so got $50,000 more. But actually, more important than that, this client had what's called linked policies. So 2/3 of the policy was paid through the super fund, 1/3 was paid outside, and the insurance company made an assessment and said you could do any occupation again based on our assessment, because I'll always assess that first. The insurance company said, yes, we think you can. We don't meet the definition of any occupation. However, you don't meet the definition of an own occupation. So they paid $1.6 million directly to their bank account and bypassed super, which meant that there was no tax consequences. As you mentioned, money going into super and then pulling it out, you may need to pay tax, or if you're under age 60, you're likely going to pay some form of tax on that benefit. And so, yeah, that's why we are big believers in own occupation here at Skye. It does cost more. We think it's really important. If you do need that money, getting paid out a claim under an own occupation is really important to make, give you the optionality if you ever need to. So Nat, talk to me about, do we have anything else that we haven't touched on in all your research that you're like, Phil, you didn't ask me this question, idiot. So is there anything that we didn't touch on, or is there anything that you think is really important for people who are watching to take away with?
Yeah, I don't think we haven't touched on anything. I think most of it was covered. I think one thing to take away is, as you were saying about our philosophy being own occupation being really, really important for clients and for people that are looking at insurance, it's not something you can access inside super. So if people are just thinking about increasing their own and doing it in their own style, you actually can't get access to that own occupation definition, which is arguably really important because it is more specific to you. That was it.
Yeah. So I will translate that into a sales pitch. Go to a financial advisor to help set up your policy, because you've got access to these, definitions of policies that you just don't have through your super fund. If you go through your super fund and increase the cover, that's great, but you're only going to be based under any occupation. The insurer can reasonably argue that you can return to based on your training, experience, and so this own occupation can only really be set up if you go directly to the insurance companies, which there's very few who will actually do that, or through a financial advisor. So great sales pitch. I know that wasn't your intention, but I'll bring us there because I fundamentally believe whether people could become clients of Skye or not, that they should always go through a financial advisor to help set up policies. So thanks, Nat. Appreciate you taking the time. Thank you so much for doing all the research. Great job.
Thanks.
If anyone has any questions about own occupation TPD, natalia.king@skye.com.au is the place to go as our resident TPD expert. And if you do want to watch any more deep dives, you'll see some other deep dives on the screen now. Thanks heaps for watching.